We're expecting a great turnout today, and we'd like to thank all of you for participating in this webinar. Let me begin with a brief overview on how this webinar will be run, and then I'll introduce our facilitator. My name is Jessica Alfaro, and I manage the membership services at SBBN. I'm very pleased to have met or communicated with several of you earlier and to meet with the rest of you today. The webinar is presented by Cecilia Deacon, a development banker specializing in credit risk management for micro and SME-oriented institutions with almost 30 years experience in mainstream banking and an MSME consultancy. Her microfinance consulting work started in 1999, and she has assisted more than 20 micro and SME-oriented financial institutions in Asia and Africa with remarkable success in bank turnaround and in assisting in startup microfinance operations. And I would now like to turn it over to Cecilia.
Thank you, Jessica. Good afternoon, colleagues, and welcome once again to this problem loan management webinar. As a banker and as a consultant, I can say that problem loan management is the most difficult part of running a bank. This problem is contagious. It starts with one loan officer, then it contaminates the other officers, it contaminates one full branch, and before we know it, it has spread across the institution. And it is very hard to put off like wildfire. So it is very important that we know what to do in this situation in order to arrest this problem at a very early stage. Now for today's webinar, we will try to create awareness of the drivers and impact of loan problems and some of the best practices in managing delinquent portfolio. We will be discussing the impact of poor loan portfolio quality on the bank's business. We will also be presenting some of the best and worst practices in managing problem loans. We will also be sharing experiences from the field, including the tools and mechanisms used in managing problem loans. Now let us do a quick review on the impact of problem loans on the bank's business. The major impact of delinquency in a bank's business is in its cost, both direct and indirect cost. If we are unable to get back all the loans that we have given to our customer, our liquidity suffers. And when we have liquidity problems, we have no option but to keep borrowing funds to sustain our business. And our interest and income will also be gone. And in the course of offsetting savings to repay some unpaid installments, we will be losing a big part of our savings portfolio. And of course, the most serious one is the increase in loan loss provision. This is one cost that will eat up the revenue even of the good loans that we make. Now, managing problem loans eat up a lot of time. Time of the managers, time of the loan officers, time of everybody in the bank. Meetings will be done every day, oftentimes very long meetings trying to create strategies how to arrest this problem. Now, when the stress level rises, our staff gets demotivated. Long working hours, pushes from left and right to collect, and produce good loans at the same time will become very heavy for them to absorb. And the sad consequence of that is because of too much demotivation, many of them will resign. And this situation also gives wrong signal to the other borrowers. If some of them hears that this customer was able to get away of the consequences of not paying the loan, of course, that will also encourage the others not to pay their installments as well. And when that becomes a public knowledge in the market, reputational risk rises. Depositors who will hear this news in the market, of course, will pull out their deposits. And it will be very difficult for the institution now to raise capital. Of course, who would want to put their money in your institution if upon conducting the due diligence, they see a double-digit par? Now, before we discuss the best and worst practices in managing problem loans, Jessica will walk us through one quick question.
Great, thank you so much. And we'd like to hear from you. What are some of the tools that your financial institution is using as an immediate measure of managing loan delinquency? So if people could start typing into the chat box, we're going to take about 1 minute here. So this is the time we'd like to know what tools you are using and what you immediately used in terms of managing any problem loans or any loan delinquencies. So we'll take just about a minute here. All right, so just about 30 more seconds. And this could be in terms of any reporting that you're doing, any tools that you're using in order as an immediate measure for loan delinquency. Great. Okay, thanks so much. And Cecilia, we're getting in some responses in terms of NPLs is actually the item that most of our teams are using here. The financial institutions are looking at either the NPL percentage, or they're looking at a loan installment due report. Some other institutions are talking about how they actually communicate with the borrower, so communicating with the personal guarantors, or contacting the borrower, and a couple others are talking about sending letters as sort of a second step.
Great.
And so, Cecilia, maybe you can share with us what are some of the best tools to be used from your perspective for an immediate measure for managing loan delinquency.
Okay. Some of the tools that are very important are, number one, the watch list. That will show not just the very problematic loans, but also those that are already showing some problem loan signs. And then another report is also the PAR report. That will show PAR report can also be broken down into much deeper analysis, like the report that tells you the PAR per branch, per product, and per loan officer. So those are just some of the few. I know that some institutions also have very good reports that they use and are very effective in managing their problem loans.
Great, thanks, Cecilia.
Okay. Now let's look at the best and the worst practices in managing problem loans. Best practice financial institutions, best practice SME banks use two sets of actions when this problem strikes. They do immediate actions and they plan also the long-term actions. The immediate actions are some of the quick fix that need to be done at that certain moment. However, the strategy should not be limited to the short-term actions. Some long-term actions should also be planned and implemented so that in the future, when this present situation is over, in the future, it won't recur. Everybody will be guided accordingly by the long-term plan, and the chances of that problem coming back will be reduced. Now, one of the best practices is creating a watch list of accounts showing signs of potential problems. In the course of visiting customers, loan officers should be made to take note of the observations in every visit. Even if a customer, for example, has not started missing on payments, it is important to note, for example, changes in the inventory level, changes in the number of customers coming to the shop. If there are changes also in the workers very often, now those are red flags that can signal that this business is suffering some setbacks. Now, these kind of scenarios should be taken note, and then those customers must be listed in the watch list. And it is also very important for everybody in the bank to have a clear understanding of the situation. It is very important to determine, is the magnitude of the problem within or beyond the normal threshold? Now, what is the normal threshold? Best practice SME banks adopt the 3 or 5% cutoff of PAR. The goal is to keep PAR below 5%. In fact, I have visited some institutions where everybody gets jittery once their PAR hits 2.5 or 3%. So that shows that everybody in the institution is aware of the point where they have to institute very, very quick measures in order to arrest the problem. Now, we should also classify problem loans according to probability of collections. Of course, when customers stop to pay, we have to ask everybody to run and collect. However, at some point, we may not be aware that the problem is not just collection, but something else, like, God forbid, it could be fraud. So it is critical for management to come up with the list of all problem loans and establish which of these loans can still be collected and which of these might need to be written off. And our field workers, our loan officers are in the best position to do the classification. And then strategies, courses of action will be planned according to the classification of the problem loans. We should also brainstorm more frequently with the team and create action plans and assign responsibilities of every member. For example, some of the members of the team can be assigned to focus on one branch that has the highest delinquency, or some of the members of the team may be assigned to deal with one customer that has a very big outstanding balance that has been delinquent. So with this sharing of responsibilities, results would be more faster and everybody will get involved. We should also set milestones and performance indicators. For example, branches should be informed that in the next 2 weeks, for example, PAR below 30 days must be brought down to 0. Or in the next 30 days, PAR between 61 and 90 days should be brought down to 3%. And once milestones are set, management should look for results from everybody who are involved in the activities. Milestones will be meaningless if nobody follows up what has happened, for example, after 2 weeks, after 30 days. Now, once in a while, it is also very important for us to review our plans. There may be, at some point, we might need to do some revisions depending on the circumstance. And we should also put in place clear guidelines to follow in managing delinquent loans. Now, all of these immediate actions will keep going if everybody sees very clear guidelines. Now, here are some of the long-term measures. Best practice SME banks create a problem loan committee. This is not the credit committee. This is a separate committee. Now, what does the problem loan committee do? This committee guides everybody in the bank how to detect signs of problem loans on a day-to-day basis. They interpret all the loan reports, and if they see some signals of problems coming, they plan out, they provide guidance, and they talk specifically to the branches involved. They identify where the problem starts, and they will also do constant follow-ups on results. It is also important to brainstorm with the management team on the appropriate ways to eliminate causes of problem loans. We meet with the management team not just when there is crisis, but also also for the purpose of instituting measures to eliminate the causes of problem loans. Now, we should also draw the roadmap with desired results in implementing action points. Even if we come up with 50 to 100 action points, if the roadmap is not laid out, like we start from this action, we proceed to this action. If we don't see results, then we revert to this direction. So the roadmap will guide everybody in the bank which action is best suited at a certain point in time. And the effectiveness of our strategies should be regularly assessed. There might be some strategies that will be ineffective. If circumstances change, for example, the strategies won't lead us to the result that we desire. So at that point, we have to do some revisions and adopt a different approach where necessary. Now,
Cecil, this is Jessica. Before you move on, we just had a really good comment. When we're getting in some good questions, which I'm going to save to the end, but we had a good comment from one of our participants in India, and he just wanted to share that you know, it means that you really need to have consistent follow-up and be consistent for each of the different accounts each and every time. So I just thought that that was a really important piece to share in terms of what you were discussing and with the follow-up and the roadmap, that the consistency is very key.
Yeah, that is very good. So thank you for that. Now more on the long-term measures. It is also very good to put in place incentives for customers who pay on time all the time, and to impose penalties on delayed repayments at the same time. Now, what are examples of incentives? Now, the institution must set aside some budget, not big amount, just small amount, to give recognition to customers who never failed to pay their installments on the dot. The most common practice is give them discounts in, for example, the charges in their next loan availment. Give them rebate at the end of the term if they have not missed on any single installment. Or you can buy some token, very small items that will show your appreciation of their effort to pay their loans on time, all the time. Now on penalties, in some environments, penalties are regulated. Like central bank might say that you cannot impose penalties beyond a certain percentage. However, it is important that every institution must put in place some form of penalties to discourage customers from missing their installments. So what are the worst practices in managing problem loans? In many cases, our emotions, when we wake up one morning to see that the AR has already reached double digit. Now, reactive measures will not create good results. Like the plaster approach or firefighting. Plaster approach means we react immediately to the signs that we see instead of holding back a little bit and try to see the bigger picture. So we can strategize what needs to be done in order to arrest the causes of these problems. Now, some institutions also make the mistake of firefighting. They institute a lot of measures when the fire has grown so big. But when the problem starts reducing, everybody also relaxes. And when the fire flares up again, then they start running. So if that is the reaction that an institution adopts, this problem will always recur over and over again. Now, treating our customers badly, even if they are delinquent customers, is not also good. The tall order that we give most of our clients is to deal with customers in a firm but gentle manner. Meaning you have to be consistent with the approach that you make without being harsh. Sometimes the difficulties that our customers are in could be temporary. So when they are out of that problem, they are still very good potentials for business. If you treat them harshly, they will never come back to you. Now, resorting to loan restructuring without clear policies and procedures is disastrous. Now, loan restructuring is often misused and overused and even abused. If we do this, it can hide so many problems, even fraud, because your portfolio, the branch's portfolio, would look normal, they would look good, all the problems are hidden under the carpet. And you'll only wake up one day seeing that these restructured loans are getting worse over time. Now, one of the best solutions if you have to do restructuring of problem loans is to classify them separately. If you mix them with current loans, you will also be hiding your problems under the carpet. And in some institutions, we also see that there is no conscious effort to record the causes and impact of loan delinquency. Recording lessons learned after you come out of a crisis situation is very important. So that moving forward, everybody would be properly guided as to how the institution dealt with this type of problem in the past. So brainstorming and strategizing will be much, much quicker if you have a very good record of the lessons learned. Now, our next topic will be on the measures that we adopt under normal and crisis situation. And before we proceed, Jessica will walk us through another quick question.
Great. Thank you so much. Perfect. And so this is a time for you to vote, and we've got a very large turnout today, so I hope that everyone will be able to respond. So we'd like to know which of the following reports are necessary in managing loan delinquency. And you can select more than one. So is it the loan distribution report, the loan delinquency report, the expected repayment report, the PAR aging report, or none of the above? So please feel free to begin responding to that, and we're going to take about 1 minute to do this. So we've got some responses coming in, and feel free to select all that apply. And we'll take just about 20 more seconds. And about 10 more seconds, once we have all responded, we'll show the results. And Cecilia can share with us what are the best resorts to manage loan delinquency.
Okay.
Great. So let's go ahead and close it. We'll go ahead and close the poll. All right. And so Cecilia, I don't think you can see the results, but PAR aging report, we had about 83% say that this is necessary. Loan delinquency report and expected repayment report were right around 78 and 74%. And then loan disbursement report, we had 39% of the participants vote for that one.
Okay, good. So thank you, Jessica.
Great. And so I know you'll be speaking about that in the next slides, which are the best reports.
Yes. Now, let us look at the measures that we have to adapt in a normal situation. What is a normal situation? As I mentioned earlier, good SME banks have very good cutoff that they set as to the threshold of delinquent portfolio that they can take. Now, if delinquency, for example, is just 1 or 2%, then that is what we refer to as a normal situation. A crisis situation is when the delinquency level goes beyond the institution's threshold and even the industry's threshold. So we have to distinguish which actions to adopt in these two different situations. Now, first is on reporting. In a normal situation, reports are looked at weekly or monthly. We look at most of the time, every Friday, we generate reports and we see how the portfolio was performing in the previous days. And then we do some planning. We try to see what are the next steps that we need to do if we have detected some indications of problems in the previous week. And we also do the same thing on a monthly basis. Now, even in a normal situation, restructuring should not be considered an option. And I have mentioned the reason why restructuring should not easily be granted. Then cross-analysis of PAR trends have to be done once in a quarter. Now, what do I mean by cross-analysis? A PAR portfolio can be broken down, can be disaggregated in many ways. You can disaggregate it by loan officer, by loan product, by branch, by geographic location. Now, doing this will guide management how to strategize in bringing down further the level of loan delinquency. Sometimes you'll find out that branches located in this geographic location tend to be increasing in their PAR portfolio. And oftentimes that can be caused by some of external factors, some of external drivers that the branches are experiencing at the moment. So upon seeing that, management should be quick to jump in and try to assist that branch that is showing indications of increased PAR level. Now, in a crisis situation, reports have to be reviewed on a daily basis. Morning and evening, we have to look at reports in order to determine the trend. What was PAR yesterday and what is it today? Which branch have reduced their PAR today? Which branch have increased PAR? Which product is also indicating increase in PAR? Now, in a crisis situation, restructuring may be done, but it has to follow very clear guidelines. There has to be a very well-crafted and strictly implemented restructuring policies. And we will give you some examples of the policies in the following slides. And then collection structure will also change. If in a normal situation, customers are made to come to the branches and pay their loans, in a crisis situation, the bank usually they form what they call a task force who will follow up on collection. They will be assigned to different branches to strictly monitor how much collections have come in today, what is the percentage of reduction of the PAR for the day. And then some other options can also be considered, like hiring external collectors. If there are service providers, for example, in your area that you can hire to assist in collection, that could also be one option when the PAR level is getting out of control. Now, some tips on what are the elements in your restructuring policy. First, you have to clearly state that restructuring is only allowed in very extraordinary cases, like when there's a natural disaster, changes in regulations, individual crisis like illness or death of a family member, and if there is economic downturn. Without this, restructuring can be abused. And many of us would ask, what percentage of the portfolio may be restructured? The best practice is to limit restructuring to between 2 to 5% of total portfolio. And in addition, you have to state in the policy also that restructuring can only be done once throughout the loan term. It should not be made like a last resort. It has to be done only once, and after the customer has availed of that one-time privilege of restructuring, it has to be very clearly explained that if he fails to pay the installments of the restructured loans moving forward, then much tighter measures will be enforced. And if you have restructured loans, they have to be classified separately. In your system, you should also have a category of restructured loans where reports can be extracted every day so that close monitoring can be done. We have to keep in mind, restructured loans are actually bad loans at one point. They have only been brought to normal because of certain conditions. But in reality, they may go back to be bad again if close monitoring is not done. So never ever mix restructured loans with current loans. Now, even in your loan loss provision, best practice requires that restructured loans who are now in their normal situation should be provided higher than the current loans. Again, because these loans have gone bad in the past. Now, these are some of the reports that we would like to share with you. Collection progress by branch, by loan officer is very helpful. And when we are in a crisis situation, these reports should be pulled out every day. And then from the reports, we pinpoint some critical areas. And again, the cross-analysis of NPLs is important. If, for example, over time, we see that certain loan products are seeing alarming increases in the PAR, then maybe at that point, management may decide to suspend offering that particular loan product. If there are loan officers also that are showing signs of increased PAR, then management will have to institute measures like putting on hold the authority of that loan officer to generate new loans and ask them to focus on collections. Even in the case of branches, if some of the branches show an increasing level of PAR, then they may be asked to stop from giving new loans and focus on collections. Now, some of the best practices in managing crisis situations, specifically in monitoring structured loans. First, you have to watch the trends of the movements of restructured loans. Anytime that one restructured loan fails to pay one installment, then tighter measures must be done. you have to apply stronger pressure soon as one restructured loan misses an installment or two. Now, here are some of the very common measures that SME banks use in measuring their NPLs. One is the percentage of installment in arrears, and another one is the portfolio at risk ratio. Now, these two measures are not the same, and we will see in the next slide the difference of these two. Now, this report has 5 columns. The first column shows the category of the portfolio. Second column is the number of borrowers. Third is the installment in arrears. Then the outstanding balance and the total loan outstanding. Now, the third column shows the amount of installments that are unpaid at a certain date. Now, using this example, we would like to show to you the difference between the installment and arrears ratio and the portfolio at risk ratio. Now, in computing the installment and arrears ratio, you divide the total, 12,450,000, by 100 million, which is the total amount of the portfolio. And that will give us like 12.5%. So if you use installment in arrears ratio, you will find that the ratio of your bad loans, quote unquote, looks like it's only 12.5%. Now, what about PAR? PAR requires that you compute not just the unpaid installment, but the outstanding balance of all loans that have missed one installment. So in this case, for example, the numbers that you use will be the sum of the fourth column, which is 50 million, divided by the total loans outstanding. And that will give us 50%. So there is a very big difference if you of using these two different ratios. Now, it is very important that best practice SME banks use the PAR, the portfolio at risk ratio. This is more conservative and this is more realistic actually, because once an account misses one installment, it actually means that the entire outstanding balance is already at risk. Now, in conclusion, we would like to reiterate that sound loan delinquency management measures can minimize its impact on the bank's business. And knowing what measures to apply in a given situation is very important, like the normal situation versus the crisis situation. Then restructuring must be controlled. And finally, restructured loans must be classified as such and closely monitored. So thank you so much. And I think at this point, Jessica will be taking more questions.
Great. We actually have quite a few questions that have come in at this point in time. I did want to go, could you go back to our poll slide question, Cecilia? We did have a question on which were the best reports. So if you don't mind going back to that slide.
Mm-hmm.
And we can just make sure that we have those details to share with everyone.
Mm-hmm.
And so I think a couple more slides back. Great. So one more forward. There we are. So which are the best reports in managing loan delinquencies, Cecilia?
For me, expected repayment report is very critical. The expected repayment report will show you both the unpaid repayment and also the upcoming repayments. Now, this report will allow the loan officers, the users, to manage both the delinquent and the upcoming installments at the same time. So I find this report very, very proactive.
Great. That's very helpful. Any other reports, or is that the main one?
That's the main one, and the par aging report. And as I said, par aging report can be further disaggregated by PAR by branch, PAR by loan officer, PAR by loan product.
Excellent. Okay, so I am unmuting Abdullah Al-Mamoum. Can you hear me?
Yes, yes.
Abdullah, great. If you want to speak just a little bit louder, I'll let you go ahead and ask your question directly to Cecilia. And Abdullah is calling us in from IDLC.
Well, Cecilia, my question is, which works best for our company? I mean, centralized delinquent management team or a decentralized delinquent management team?
Now, in a crisis situation, a centralized delinquency management team is more effective, so that everybody will be following the same roadmap at the same time, and it will be easier for management also to ensure that the measures implemented across the institution is consistent, and if there are any changes or any additional measures, it will be much more easier to implement if the team is being centralized.
Okay, thank you.
Great, thank you. And we have another question that's tied to that as well. I think you did answer it a little bit, but who really drives the loan delinquency management in an organization? And when you're talking about these committees and these task forces, who should be involved in these committees as well?
Now, first, the problem loan committee should be on top of driving the problem loan committee management. Now, who are the members of the problem loan committee? Number one is the head of credit, then the head of business, and in many institutions they also bring on board the head of operations. Reason being, the head of credit is the holder of the credit policies and procedures. And they are actually, they are the custodian of the portfolio. Then the head of business should also be brought on board. They should be on the same page so that they will also drive business in line with the existing situation of the lending activities. And then the head of operations, which is in charge of recording the customer's repayments, reconciling balances, they should also be brought on board so that if there are issues, in some cases, for example, delinquency is caused by wrong posting of loan repayments, then the head of operations also will play a critical role in order to assist the head of credit and the head of business in managing the loan portfolio.
Great, thanks so much. And we have a question from Oswell. Oswell, can you hear us? There might be a little bit too much background noise. Oswell, I'm not sure if you can hear us.
There's quite some noise.
Oswald, if you want to ask your question directly to Cecilia.
Yeah, I think the question is almost same with what she was explaining on the problem loan committee, but I wanted to get clarity on the terms of reference of the problem loan committee.
Great. Okay, so I think we have answered that question, and that had to do with the problem loan committee. Great. So thank you so much, Oswald. We really appreciate that. I'm taking you off of the mute then for that. And a couple other questions had to do with how we can measure the probability of collection, and I think this is a big one for institutions. You know, if they're doing all of these different tools and you know, putting together these different committees, what are maybe some benchmarks that they can use, or what are some tools that they can use to plan for how much they're actually going to collect?
Now, probability of collection mostly depends on the age of the delinquent loans. Now, several studies show that loans that are below 60 days have much higher chances of collection than loans that have crossed the 60-day threshold. In fact, I have read one article written by one of my former colleagues that the chances of write-off increases as the age of the delinquent loan progresses. So the aging report is very critical, and we have to be aware that the aging will indicate the probability of collection. I have seen one institution that has loans, delinquent loans in their loan book that are beyond 90 days. And over time, I monitored the percentage of that portfolio that they were able to collect. And after 6 months, the result was 0, which means the longer the age of the delinquency goes, the probability of collection decreases. We have also interacted with some specialists in collection. There's one institution that specializes in recovery of bad loans. And I asked him, what are the probabilities of collecting loans, delinquent loans that have been overdue for 1 year? And he said, you'll be lucky if you can recover 1% of it. So the message that we would like to send our colleagues is that immediate action is very critical, because if we wait until these delinquent loans cross the 30-day threshold, then our chances of recovery will be much, much lesser.
Great. We've got a couple questions coming in about restructuring, and Patrick in Zambia is going to ask you a couple questions on that, and maybe if you could also speak about it, Cecilia, in general, just a little bit more in depth, since we've had some further questions on restructuring. But Patrick, I think you're unmuted now. Can you hear us?
Okay, this is Chanda.
Hi, Chanda.
I'm with Patrick here. I just wanted to find out, I had seen that you had put a couple of reasons where loans should be restructured, but among those reasons, you had, what happens when a loan is poorly structured by the loan officer and approved by the credit committee, and then it becomes delinquent? Is that a valid reason for you to restructure? And then after you restructure, should you treat it the same way as the loans that are delinquent, because probably the customer is just delinquent?
Yeah, Chanda, regardless of the reason of delinquency, all restructured loans should be treated equally. The tighter measures should be applied to all restructured loans regardless of the reason why they have fallen delinquent. I agree with you that sometimes loans can become bad because of poor structuring in the first place. However, based on the fact that the customer has failed to pay some of the installments, once they are restructured, we have to classify them the same way as we classify all restructured loans, and monitoring, and if there are like special actions that we impose on all restructured loans should be implemented equally.
Great. Chanda, did that answer your question? Anything further on that?
No, that's fine, thanks.
Thank you. So we had a couple questions coming in as well about the number of accounts that either a collection officer should be monitoring or that a loan officer should be monitoring. So maybe you can talk to us a little bit about that, Cecilia, if you have any ballpark figures on, if I'm a loan officer and I'm monitoring accounts, how many I should monitor, or as a collection officer, how many delinquent accounts I should be taking care of.
Okay, thank you. Now, establishing caseload for collection is the same as establishing caseload of the loan portfolio. Like best practice for institutions that do individual lending, for example, the caseload assigned to one loan officer is between 80 to 100 customers. Now, when it comes to collection, I would say that the same threshold be also followed, because we're talking about level of effort here, which is based on the number of customers that they will be dealing with. Now, in microfinance institutions that are doing group lending, the benchmark is much higher. It's between 300 to 400 customers for every loan officer. Now, I have visited one institution in India where one loan officer handles 800 to 900 customers. They do purely group lending, but I would say that that is a very exceptional situation. Now, for SMEs, relationship officers are expected to maintain at most 60 active customers. Reason being that relationship management for SME customers, it's much more demanding. So spending time with them, trying to do some cross-selling and developing relationship would take much more of the loan officer's time. So that is the reason why the number of loans required is also much lower. And to add to that, they will also be dealing with larger loans. So they have to spend a lot more time in appraising the loan, in managing, and in dealing with the customer in general. Because customers will not only be transacting with the bank on loans, but also with other products like deposits, some transactional, some fee-based transactions. So in terms of time, it's more demanding on the loan officers.
Great. We're going to take one more question. And again, I'd like to thank everyone so much for participating and invite everyone to join our post-webinar discussion on our LinkedIn page, we'll go over some of the unanswered questions and delve a little deeper into some of these themes as well. So we will send around a follow-up email with the link to that discussion, and I invite you all to join our SBBN LinkedIn group and also to respond to our discussion on any follow-up questions from this webinar. And so, Cecilia, for our final question is around PAR, and what is a PAR percentage that should cause alarm for an institution? So what should we be looking at there? And then also, you know, if there's any sort of general tips for an institution to reduce an overall PAR. And that might be good for our LinkedIn discussion, since that's a pretty big question.
Yes, it is. But to start with, let me say that the moment that an institution sees PAR in the report, everybody should be alarmed immediately. However, the level of action that has to be done will be different. I mean, the respond will heighten also the higher that the percentage will go. But as a threshold, institutions should make sure that PAR does not cross the 5% limit. Now, when PAR crosses the 5% limit, then that institution will definitely be under crisis. With more than 5% PAR, loan officers will be spending a lot of their time following up on non-paying borrowers. So as I said, the higher the PAR goes, the more intense the action will be. But the alarm should start the moment we see like 1% PAR in our loan reports.
Great. Well, thank you so much, and I think we may answer the second part of that question in our LinkedIn discussion. But again, I'd like to thank all of our participants. We had over 20 financial institutions join us today, so thank you so much for a great audience, very participatory, and we hope that you will join us at the next session. And we would also like to say thank you so much to Cecilia for an excellent webinar on preventing and managing problem loans and loan delinquencies. So thank you so much.